we start from the SEC Commissioner, Amatong.
Thank you very much. Thank you very much to Dennis for that excellent presentation. At the beginning, he was concerned. He was joking with us at the table to be gentle with him. And I've been in that position, so I know what that feels like. But I'm in the unusual situation for a regulator, unusual but very happy situation for a regulator where it doesn't happen very often, but this is an instance where the private sector's perception of the opportunities available in the market happens to coincide very, very well with the regulator's own perception of the market. So don't worry, I really have nothing to swing at you. You've more or less agreed with everything that we've perceived on the regulatory side at the SEC. One of the things that Mr. Montecillo pointed out that I wasn't too big on, but I realized now is very true, is that I probably should thank Governor Pitaco for putting all of these people in the room. Dennis is alluding to the bank regulations imposed by our BSP, which effectively puts a cap on the amount of exposure that banks can have on infrastructure bonds. And I'd like to respond to his challenge for coordination among government, that in fact we are in dialogue with the BSP. And maybe coordinating is too strong and optimistic a word for government, but we're definitely talking to each other, and we are trying to facilitate a better environment for the capital markets, and we are working together. So I probably should thank the BSP for your spellbound attention at this conference. The other thing that I'd like to point out is, as Dennis has pointed out, there is a lot of liquidity out there. And from our point of view, that liquidity is likely to increase. In fact, to be here today, I've had to excuse myself from a meeting at the Commission where my fellow colleagues are actually meeting with a very, very large European fund manager that's looking to come into the Philippines. Well, I won't disclose that right now. We'll make sure that they can come in, but they're looking and they're meeting with us right now. So a lot of people, I think, agree with you, Dennis, and that there are a lot of opportunities in the Philippines and a lot of opportunities in the infrastructure market. And with our current regulatory regime, project bonds is coming back as a viable possibility of financing or funding this need, and as a hope for all of that liquidity that's trying to find a productive use. Our role at the SEC is trying to facilitate and enable that kind of investment. And while we don't pretend to have done a perfect job, and as Frederick was mentioning to me a while ago, we all have very strong memories of 1997. I might not look it, but I am of a certain age where I can remember certain things, and 1997 was very traumatic. So we're working very hard in the regulatory space. In fact, I've been working with Charles and Buho for some time now. The government's been trying to facilitate CGIFs. Buho will, of course, talk about CGIF. But we've been trying to facilitate and enable their participation. We've been taking some very good advice, and we're trying to work with Treasury to make the bond market work more transparently and work better for all of you. And so we're here right now. I'm going to have to run right after this, but my staff is in the audience right now. And we would be very happy to hear from the private sector as to what we can do better and what we can do to help facilitate all of these investment opportunities. Thank you very much.
Thank you very much, Jeff. Maybe hear from Charles.
Sure. First, maybe just a few comments on Dennis's presentation. The deals that Dennis had in the presentation were interesting ones. They were in the middle of the credit scale, mostly supported by the project So definitely looking more like corporate bonds than they would government bonds, which has really been my role for a long time. What I'm most familiar with the infrastructure bond model is actually Central and Latin America, where the Treasury had a partnership with Chile to kind of help export its model to the rest of Central and Latin America, especially the countries in Central America that have had some difficulties, Honduras and El Salvador. I work in Costa Rica. The Chilean model is really interesting because it really brings to a forefront the concept and PPPs of risk sharing, where in contrast to these double B rated deals, the deals in Chile were all rated AAA, and they relied on multiple levels of credit support and some government guarantees. Now, I've been working as a debt advisor for the Treasury since 1999. We, as advisors, and maybe the IMF and others, the World Bank, we have for many years taken the line, too many guarantees are bad. Guarantees increase public debt. They have risks that can't be seen, that they're always bad. And I think now maybe it's a little bit controversial, but I'd say that the Chilean model definitely demonstrates that the guarantees can play an important role and they can be appropriate. And I think they're definitely appropriate in the context of risk sharing, where that's the government's side. And the other thing that Dennis and I were talking about beforehand was that this guarantee has market value. And where Chile attaches these guarantees to the deals, once it's in the takeout phase or after the construction phase of the project, it can be very valuable. And also because Chile's PPP projects and financing was timing to coincide with a big pension reform. Having high-rated deals mean you put quality assets into the pension funds. So right now in Chile, the pension system has 20% of its assets in infrastructure financing. But anyways, just two more comments. I just have comments. A few that says yes, the Philippines is ready. It's a good time. We're ready for project bonds. And maybe a few comments saying, well, maybe not. First of all, just gatherings like this will show you that the markets here are ready for more products and new products. There are real sophisticated investors here. There are institutions that can structure deals. I think there's a lot that we need in place already. Even the regulators are a pleasure to work with, and they're open-minded. The government in general puts a priority on these kind of issues, so I think it's all looking very good that way. And in fact, in contrast to Latin America, where they've had a lot of success, things are even better here. In Latin America, that get long-term, investors weren't really willing to take long-term debt in local currency. So they had to use a lot of foreign currency guarantees. They had to inflation link a lot of the deals. But here we can already see, even in the primary market for government securities, investors will buy at reasonable levels long-term fixed-rate debt, even while the liquidity of the market still needs some improving. So that's a really good sign. It shows that, yes, we're ready, in many ways ready. Also an interesting thing, similar to how Chile had pension reform going on at the same time, in the Philippines you have this Ephyro reform coming with millions of new investors starting retirement accounts. They're going to need safe assets and long-term assets. Long-term corporate bonds would definitely be a good vehicle for those type of accounts. So, and I think that points to the fact that not only is this a good time, but it could be a critical time. And just as far as, well, maybe Philippines is not quite ready. F&I and others, we still have a lot of work to do in developing the government bond market and more basic markets like the money market and the FX market. They need to support these more complicated structures like bonds. And that's basically it.
Thank you very much, Charles. Maybe hear from Hock, please.
Thank you very much. First of all, a sincere appreciation to the government of the Philippines for the invitation. sponsors to this. It's really high time we talk about project bonds. I think there's this moniker about Philippines being the second half of Asia. I do not agree. Even if it was never, to me, if anything, it was a sick child. And to move forward as what this administration is doing, to speed up the rehabilitation of the Eurasianist child, infrastructure investments are critically required. So this is one of the few countries that are young. Nobody's talking about the aging population here, so it has a tremendous potential. So how do we get infrastructure finance? And the discussion today isn't so much about this administration, next administration. It's actually for generations of people who call Philippines home. Right? So we'll talk about CGI later in some of the meet and greet sessions. In the interest of time, I just want to share with you I'm Malaysian. I spent 20 years in the ringgit bond market, and it is amongst the ASEAN countries the market which has 100% GDP, the size of a market which has equivalent to 100% of GDP. Comparatively, in the Philippines, it's about 36% GDP. So there's a lot of work that needs to be done, and there's a lot of work that can be put in to get Philippines to reach what Malaysia has done. So let me share with you some insights and anecdotes of the 20 years in Malaysia. I cannot say that I have the stripes on my sleeves, but I can tell you that I have enough to share of the scars underneath the sleeves in Malaysia to tell you what needs to be done. First of all, local currency project infrastructure non-recourse bonds are high-grade, high-yield bonds. They are not lowly rated. They need to be highly rated because they're sold to pension funds and life insurance companies. It cannot be triple B rated internationally. It cannot be double B. They are double A and above in the local national scale because it's my money that's in that pension fund, and I'm going to need it when I'm 55. So in that context, the development of the local currency bond market is essential. There are some examples in the past, and you notice that there were dollars. But we notice when we turn on the switch or turn on the tap, people pay for power, people pay tolls in local currency. So you're not going to really find a sustainable financing mechanism other than local currency. So one of the most important things about developing a local currency bond market is looking at the savings propensity within the country. I think Commissioner Ephyro were at the conference, and it was shocking that the Philippines' long-term savings as a percentage of GDP or in absolute amounts is actually still quite low comparatively. So I think discussions around that need to happen. There's a lot of liquidity, but if it's in 3 months deposit, 1 year deposit, it's of no use because you're going to have a lot of cost trying to intermediate that money into long-term 30-year money. So the trick is to try to get these deposits, although they're 3 months, they're actually long-term because people don't take money out of the bank. So how do we get these funds to go into long-term bonds and lock it there for 20 years? That's important. So, and then if we're starting from this position and we look at internal capacities not adequate, right? So we don't have savings, long-term savings indigenously here, then we really need to think about how to attract funds from outside, regionally, into this country. And I'm happy to note that the government has extended an invitation to, at our suggestion, to the Employee Provident Fund. Madam Anna, she's at table 23 from Malaysia. She manages, the fund has $200 billion of long-term savings, which really finances most of the infrastructure in Malaysia. So on that vein, I encourage all of you to speak to her. She has some deep pockets. But certainly, I must not kid you, her risk appetite is extremely of high standards because my money's there. And I can't draw it out until I'm 55. So, and I would know how this works. I just want to explain how this works. Every Malaysian, when they work, 23% of their paycheck gets deposited into the fund and cannot be withdrawn until they're 55. So, these are the things that, blessings that Malaysia has, and there's certainly steps that the Philippines can take to try to institutionalize long-term savings. But coming back to my point of attracting people like Madam Anna here, right? We've got to address the risk appetite. And secondly, we've got to address, and I've talked to the Commissioner on this, withholding tax at 20%. So we're very good. All countries are very good at FDIs. You know, we'll give you tax holidays or immense amounts. But for bond investors, the welcome gift is a 20% withholding tax. And so when monies come from abroad and they go into the roads, and they could go out, they could sell the bonds. But it's a 20-year bond. You could buy back the bond at 50 cents to the dollar and you get a discount. Because foreign investors cannot take the road out of the Philippines. Right? So the idea is to open up, make it very conducive, regulatory-wise, for investors, regulatory-wise for the projects, to get people to have confidence to invest in these projects that we're seeing potentially. And secondly, there are just a couple more points, and then my time's up. We need credible supporting institutions, whether it's in the form of rating agencies, technical consultants, and we certainly need investment. So we need, in this market, leadership. People who invest in people who are extremely well-versed in debt service coverage ratios. Right? And beyond that, I think we can do a poll later. How many people here are from the credit risk department, from the back offices? They're not here, right? So we need to invest in the skill sets, getting them up to speed with investing in non-recourse project bonds, right? Because it is very different from buying a corporate bond that finances a project. And lastly, I think we're time's up. But I love Dennis's slide, and the last slide, where there was a hand out, reaching out to help each other. I would say Malaysia's hand is available. And I would encourage everyone, from the regulations, to the rating agencies, to the investors here, to banks, to reach out to the counterparts of project bonds in Malaysia. It's a 3.5-hour flight away. And I'm certain the Malaysians will be happy to help share the trials as well as the tribulations. Thank you very much. And Commissioner says the food is very good, so it's worthwhile making that 3 hours. Thank you.
Thank you very much. May we hear from Frederick, please?
Good morning, everyone. Maybe obviously I'm at the table because I'm the account for the issuers for project bonds. I used to work here for a US monoline in the London market, and the reason I shifted, I used to be doing bank deals, investing in PPPs in the UK, and I decided to move to the bond market back in 2004, was that I think that if we take a bit of a distance globally to look at the global situation, there are forces at play that tend to indicate that the bond market should be the vehicle of choice for infrastructure financing, because infrastructure projects typically need long-term finance. And principle number one, project finance should be to match your asset life with your liabilities. And the longer you can stretch a debt through PPP mechanism, the lower the ability payment the government needs to make. So from a budgetary point of view, governments really want to have long-term financing. And the other point to note is that the regulators have been pushing effectively the bank to account for more capital beyond year 15 under Basel III regulations. So doing long-term financing for the banks in terms of pricing is going to be, if banks apply the Basel III rules, it's going to become more and more expensive. So that should favor the emergence of the bond market. The other thing is for the insurance company, similar regulation to Basel III for insurance company is called Solvency II. And there's also an incentive there for the insurers to invest in a long-term asset to match, again, their liabilities to pay pensions in 20, 30 years with the investment. The bonds they could invest in, and bond could be again the vehicle for such investment. So that's for the global scene. I think there's a general scene there. Where does ADB can play? You know, where can we help on this? We have something very peculiar. We are a AAA institution, and monolines used to be AAA as well. And when I was recently discharged from that situation in Chile, the monolines were very active in the financing bonds at AAA level, international level. So bonds could be sold in the international market. And the access is very long-term maturities. I mean, by way of background, just to mention, the last bond I personally worked on in the UK market, because before the demise of monoline in the beginning of in 2008, the last deal I closed was in July 2007, sorry, and that was for a 37.5-year amortizing bond for PPP hospital in the UK, around 500 million sterling, so $1 billion then. So this was a market which was active in Europe, and we would like to revive this market in Asia. And since July 97, the case of the last bond issued in the Philippines. How can we help? Again, because it's AAA, because of our AAA, we are, by the way, SBL exempt from the point of view of the central bank in the Philippines, and we are 0% risk weighted. So whatever we guarantee or put a wrap around it would be not count against SBL. Solving modern issues in many local markets, that's a big issue, because there are a certain set of local sponsors who basically are close to or getting close to their SBL limits. So again, cycling of capital that Dennis was mentioning could be allowed. And we basically would like to help on this in this manner, kind of making the market more fluid. Because as Bob mentioned, one of the challenges for investors in many markets, and that was the case in Europe at the time when I was working in the online industry in Europe, investors didn't invest in teams to understand this very complex project finance skill sets that you need to acquire to be able to analyze a project bond effectively. So they were relying essentially on delegating their credit authority and some of the structuring skills to the monolines, who are specialists at doing this type of structuring. And that takes a lot of time. And to be referred to investors, sometimes investors don't want to invest in these long-term skill sets. What we've seen and what's interesting to mention as well is recent experience in Europe, where we've seen the emergence of insurance companies setting up funds, employing ex-monoline employees, actually quite close to this, to create these teams and be able to invest direct without any credit enhancement direct there. But in Asia, in Europe, the deals tend to be BBB- underlying, so people are having to take that view as to what they can take on their book, and see once the yield corresponding to that rating. But in Asia, we're facing countries like Philippines, which are, is investment grade by both agencies, BBB range, but projects will be somehow below that, probably at double B plus and maximum, So we basically, there's a need for this credit enhancement for the investors to be able to invest in that market. And what's been also interesting in Europe, the European Investment Bank, which is another multilateral, has created successfully a market, or revived this market in Europe, with 5 successful bonds being issued in the last 18 months, where bonds have been issued at the long end, 20 plus years. So again, going back to my first point of what I was saying, that we need, governments really want long-term financing. And what's also been interesting more recently in Europe, and what they've done, the product is a product where the EIB provides a unfunded, subordinated liquidity facility. So they provide, as I said, the transaction is going to be underlying rating of BBB-. By putting a subordinated liquidity facility, the rating is enhanced from BBB- to BBB A- at the maximum. So that's the kind of soft spot for investors to invest in long-term debt in Europe. The last point I would like to mention is that we often think of bonds as a tool to refinance or to brownfields. Because the reason for that is because people think of negative cost of carry. If you were to issue a bond for a greenfield, unlike a bank facility where you can draw over time, typically a bond is drawn day one, you need to invest the money and you get a negative cost of carry compared to what you have to pay on the bond. What's been very interesting in the last two transactions I've mentioned in Europe, the first transaction was the 580 roughly million euro 20 plus years bond for a equity-based toll road in Belgium. The investor, which is an Allianz Global Investor, was happy to take 444 million euros of bonds on a staggered basis. So they agreed to fix effectively, and buy at par at future dates. So effectively eliminating the negative cost of carry. So even for greenfields, we see now some interest. And that was further validated beyond what Allianz accepted on that transaction by a group of those 10 or 12 investors investing in the last deal, which was closed in Europe, which is called the A8. It's a growth and equity-based in Germany, where 12 investors actually accepted that condition. So even for greenfield, we see the interest coming up in the international bond market. And I would say we would also like to play as ADB and work with CGI to supplement capacity for local bonds. And we also could think of US dollar bonds for projects which have a dollar stream, like some the previous presentation was mentioning airports. It could be LNG projects where you have a dollar stream. It could be valid to think of US dollars, or refinancing prior IPPs in the Philippines, where there was a structure where there was a US dollar tranche and a local tranche. So we see a lot of potential to develop that market in the next few years. And I'll stop there because my time is up.
Thank you very much, Frederick. We have about 10 minutes, maybe 3 questions from the audience. We have mics there. Just kindly state your name and organization. No questions?
Can I just say one more thing since there aren't any questions on this on the last minute? It looks to me like there's about a third of the audience of non-Filipinos and about 2/3 Filipinos, right? Approximately. I'd ask you to do one thing during the break. If you're a Filipino, I'd encourage you to go up to a non-Filipino during the break, introduce yourself, exchange cards, and ask that person why they're here. And try to understand whether or why, most likely why, because they wouldn't be here if they weren't, I suppose, why they seem to be hopeful, excited, or optimistic about the investment opportunities here. And more importantly, after that conversation, ask yourself whether they're more excited about this than you are. Because if that's the case, then you've got some soul searching to do. And for the foreigners or the non-Filipinos who are here, who do get to meet the Filipinos, I would ask you to help us Filipinos, see outside of ourselves and help us show a mirror up to us and help us realize that we can be better than we are. Because I think that's what's going to get this thing done. Everybody around here really rising to the occasion. This is not going to be easy, but I think we have no choice.
Thank you for the excellent presentation, Dennis, and for the comments from F, Charles, Hock, and Frederick. Thank you very much.